So yeah, just for the break, we were talking a little bit about Ford and value investing, and this. And Rich brought up a great point here, which is there is a thing called a value trap. Just because something is cheap price-wise doesn't necessarily mean it's a good buy. Sometimes things are cheap for a reason, and that's always the one. But it's hard for people to understand that, and particularly when you look at. It was interesting. I got an email from a guy yesterday. And he says, hey, what do you think about these stocks? He says, do you think these are good long-term investments? And so I've started pulling them up, and they're all trading like $1, $1.20, and price to cash flow is just, PEs are like 1,250, this type of thing at $1, right? And I was like, no, these are not good long-term investments. These are speculative at best. I mean, you're gambling. But yeah, just because something has a low price, and good, Ford's a great example of this. Look, I like the company. I like their vehicles. I owned a Ford pickup truck for a long time.
Well,
and I think they're doing some of the right things. They're getting rid of some of their cars that aren't good sellers. They're focusing on the things that do sell.
Right.
But you got to look at that debt. I mean, they're running almost 5 times debt to equity, and that is a lot of leverage. And to Rich's point, you're in a rising interest rate environment, and you've already got a whole group of people that can't afford payments on a car. They're already having to finance 6, 7, 8 years to get into a car, and now your average payment's over $500 a month. Rental payments on apartments and houses are now at historic highs. So yeah, you definitely have to figure in the economic cycle into this. Is just where the automobile cycle is currently as well, and it looks like we're probably top ticking that automobile cycle as well. So
the other risk to the strategy, which is to move totally to the SUV platform, is that if oil prices increase, that may make consumers. That may push them towards smaller cars a little bit, at least. Maybe not in Texas, but in other parts of the country.
You didn't live in Texas,
right?
Because didn't Texas during the oil price spike when we were going up to 100, 120 back in 2008, there was this whole movement afoot out of the administration about, we need to get rid of SUVs. People need to be more green. We're all in Texas going, give me my truck.
Yeah, I'm sure.
Give me my SUV.
But this is becoming more of a nationwide issue, and I think I had the real reason for it.
Yeah, when you got 4 kids,
the infrastructure's falling apart.
Well,
therefore, I need a better truck to handle my damn road.
As someone who drives a small car, I'm sympathetic to that argument.
Listen, if you
drivers are getting progressively worse. Roads are getting progressively worse. Therefore, I must buy a tank. That's how it's working. I'm sorry.
But no, my whole issue is always this, is that, look, if you live in New York or probably even in some places in California, Chicago, where you've got elevated train systems or subways to get around.
Yeah, public transportation.
And where public transportation actually works, you can not have a car or potentially have a smaller car. Look, I got 4 kids, and anywhere you want to go in Houston is 12 miles from wherever you live. It doesn't matter where you want to go. It's 12 miles.
Okay, but let me explain something. You're a demographic freak, okay?
I'm not.
Yes, because what's going on with childbirth in the U.S.? We have a baby dearth. Okay, so people are having less children and their cars are getting bigger. I'm going back to the roads, and I'm going back to the bad drivers. I'm sorry.
Well, so when does GM begin reconstructing the Hummers again?
Yeah, right.
Bring back the Hummer.
Well, the Hummer was just a Tahoe with a different frame on it, right?
I know, but it was a wonderful car.
I don't know about wonderful.
It was all-wheel drive with a big V8. It handled like a sports car.
Well,
they were great.
Did you have one?
I drove one.
Oh, okay.
I drove one all over the state. It was amazing.
Really? For a Tahoe?
Couldn't afford the gasoline.
He ran out of gas halfway to his trip.
Ran out of gas halfway to Sealy.
Yeah, no, right. Yeah. One of the things that I think is interesting about the value investing, and I brought this up on the show once, but Paul McCulley, he used to be influential and sort of a general portfolio manager over at PIMCO, used to write some really incredible stuff during the Great Recession. And he said, listen, let's face it, everybody, investors are not made to be value investors. They don't want to put a seed in the ground and wait for it to grow.
Right.
They want a tree in the ground, and they want that tree to get bigger. So even if this was a great stock to buy, how many investors are going to purchase that and hold on to it when I think the average holding period for a stock is what now?
Less than 6 months.
Okay.
Actually, I wrote an article for Monday, actually courtesy of John Coumarianos, who sent me the article that inspired it.
About emerging markets?
No.
Because that's what we talk about.
He sent me this fantastic article by Jason Zweig, who discussed the money and the brain, how those two operate. And he makes such a great point in the story, because this is something we talked about here on the
He
show
wrote a great
lot.
book on it.
Yeah.
Yeah.
But,
I have the book.
you know,
Behavioral finance
Behavioral
expert.
finance book,
Yeah.
yes.
Right, but back in the 60s and 70s, you used to have to call your broker. So General Electric would announce earnings. And by the time it got from the company through the wire to the brokerage firm, distributed down to the actual stock broker, who then called his clients, it was 3 or 4 days before you knew that General Electric missed by a penny. And at that point, you go, they missed by a penny? Who cares? Now,
Because having a different perspective, longer-term perspective.
right. Well,
too.
it's because everything moves slower. So we had time to digest the information and make logical choices based on the investment analysis. Now what we do is, because, and to Jason's point, and it's such a great point, we've now turned the entire stock market into this video game. And it's interesting because I'm doing some work on another project
It's an electronic,
about video gaming and the dopamine effect that's created by video games. What's the most used application on your phone? Video games.
Oh.
Yeah, if you look at the most downloaded applications on a smartphone, it's social media is number 2. Video games are number 1.
I can see that.
Go look at your app, your app store. What's the first thing that's listed on all of your
actually
apps?
games.
All those stupid games.
Exactly.
Yeah.
That's because you get that dopamine effect. If I download a game, it makes me feel good because, hey, the lights are flashing, it makes noise, and my score's going up, and I'm getting kudos and awards and all this stuff. So it makes me feel good. That's what we've done to the markets. We watch the markets. If it's green, we feel great. If it's red, we feel terrible. If it's red, we don't pay attention to it. We turn it off and come back tomorrow, and hopefully it's green. But we make decisions. So as soon as earnings are announced, it doesn't matter what the earnings are. If they miss by a penny, you'll see a stock down 4 or 5 points. You know, billions of market cap wiped out in the matter of seconds because they missed earnings by a penny.
Right.
Really? A penny? That doesn't make any difference in the long run.
That's why I don't think, even in '99, I don't think online trading, I was not a big fan of it, but I don't think online trading was really good for investing
that was-
psychology at all.
That
And
was
it's-
that was the beginning of the end. That's where we turned online trading, E-Trade, Schwab, Scottrade. They were the beginning of the shift from where we took investing as a method to grow our wealth for retirement into turning Wall Street into a casino.
Yeah.
Yep.
And that is all it is now.
It is
Wall Street
legalized
is nothing,
casino, as I wrote on Facebook today.
Yeah, it is.
Yep.
But that's also why investors do so poorly over time, is because they go, oh, I love these articles that people write. It's like, oh, you should just be a long-term buy and hold investor. That's great. And it works fantastic until you lose about 8 points in the market. I got an email from a guy today going, this market's getting slaughtered. I'm like, dude, we're down like 10 points from the high.
But we talked about this, though. We talked about this the other day when we said that 2% will feel like 10, 10 will feel like 20,
Yeah.
20 feel like 50. We're not used to any kind of drift lower correction and so forth. So it's going to be, I don't know what it's going to look like.
Rich, we got that call when we were on the old show. Caller called in, and we were down 10% off the highs at
Yes.
that point in February or March, let's
Remember
say.
that.
We surmised that the fellow had a balanced portfolio because he was down 5%.
Right.
And he was really freaked out by it. He was, middle-aged guy, 50, 55-year-old guy with a balanced portfolio, which seems like it should be normal, but couldn't really tolerate a 5% 5% loss. It was incredible.
Well, and again, I've written this in plenty of stories and articles that we've written, is that when you go an entire year, which is what we did in 2017, without one negative down month,
Yep.
right? All of a sudden, people forget what a negative down month looks like. So again,
And then you start January with a 10% gain on top of that.
right.
Yeah.
And so everything's great. And then you have a 5% loss that doesn't even wipe out what you gained in
Right.
January. And all of a sudden, the world's come to an end.
yeah.
But to both of your points, wait until we get a 15 or 20% decline.
Yeah.
And it's going to feel like the financial crisis just came and started all over again.
Yeah.
And I'm sorry, all these people who are ragging on you about buy and hold, it's easy for them to do that now because the market's in a positive trend. I want to see when the hits the fan, when Brent's Hummer hits the wall. I want to see what happens and how buy and hold they actually are. I say psychology is going to take over and overwhelm them based on what we've seen so
It
far.
will
And
be
the
really-
recency bias is going to be chronic here.
All the people now who have committed to indexing, and look, it is hard to beat the index. There's no question about it. But it will be interesting to see how well they can maintain their allocations and not freak out. I have my suspicions about it.
So, well, this is part of the article that was actually published today, which is that beating an index is not the point.
That's not your goal.
It's not your goal is to beat some index, because in order to beat the index, you have to take on as much risk as the index.
Well, that's true. If your goal really was to just match the index, you wouldn't have any bonds in your portfolio. You just have 100% stocks in your portfolio,
Right.
and that's not reasonable for a lot of people.
You know, it's like having a coin with one side, because you think about, well, how much, I beat the index. Well, how much risk did you take? That's the hidden number to
Right.
get to that level of return. And that's what people don't take into account, because everybody's complacent and overconfident. But even if this thing drifts lower for a couple of months, people are going to start to question. I've already started to see in financial media, is this a big one? Is this the big one?
well,
The big what?
You can't even get 100 points down on the Dow during the day, or by the close.
Just remember that, when you're in a rip-roaring bull market like we are now, all your investing mistakes are covered up by the bull, because the bull market lifts all asset prices. But when the tide goes out, as they say, you see you swimming naked. But that's also where you discover exactly how much risk you had in your portfolio.
Right. And who's managing it and who isn't. Yeah.
Exactly. Be right back after the break. Don't go away.
Catch the Lance Roberts Show anytime, day or night, online at lancerobertshow.com.
A new professional version of Real Investment Advice is coming in September, but you can subscribe now for free at realinvestmentadvice.com and click on the RIA Pro tab. You'll have access to Lance Roberts' proprietary stock and ETF portfolios, analysis, and all of the critical investment information you need in one place. RIA Pro, the professional version of Real Investment Advice. Subscribe now for free at realinvestmentadvice.com and click on the RIA Pro tab.